Hello, my name is Rushi Patel.
And I'm Arnav Palawat.
And today we're going to be pitching Blackstone. It's an alternative asset management company that trades on the New York Stock Exchange with the ticker BX.
So Blackstone has over $1 trillion assets under management, and it's the largest AIF by far, over double almost the second place KKR. So they're the largest owners of real estate in the world, and this is 40% of their portfolio. Their four core service lines are real estate, private equity, credit, and insurance, and these are respected by size. So their credit insurance services are not to anywhere close to the size of their private equity and real estate, which make over 70% of their revenue. And going into private equity and real estate, right? They have the best recruiting practices in the industry for these two fields, as they are a globally recognized brand and extremely prestigious. This allows headhunters and recruiters to look for people over 5 years in advance, and allows for people that are in college to wait 4 years just to join Blackstone.
So I'm going to be going over the investment summary. So our investment summary consists of three main parts. Mainly is going to be our employee ownership program, Blackstone's employee ownership program. And this is what we're going to be basing our investment thesis on. Next, we also have risks hedged by the real estate investment. They have $350 billion in real estate, so there's definitely a lot of hedging there. And then finally is going to be their unique stance to the AI curve and how they're going to be riding that compared to other asset management companies.
So the main reason why we think the employee ownership program is going to be massive for Blackstone is because we saw the same thing in KKR, right? KKR kind of had their revenue stagnating around 2011, and they started this program again in 2011. And they saw massive booms in their revenue growth, over 7x nearly in from 2011 through 2023. And a basic overview of how the employee ownership program works is that Blackstone acquires a company, a portfolio company, typically through an LBO, and they place this debt upon the victim company. And then the employees of this victim company get 10% of the equity, and Blackstone retains 90% of this equity. Around this, it can vary from 7.5 to up to 12.5%, and obviously respectively on executives getting more and lower level employees getting less. And again, we think this is going to have massive implications for Blackstone and their stock price because of how important this was for other companies, and we can see exact same growth within Blackstone as their revenue has started to stagnate in a little bit. So the competition, right? I just want to highlight the EBITDA margin of 52% compared to the competition, right? So this is the big four of private equity, KKR, Apollo, Carlyle, and obviously Blackstone. And they are by far the largest with 1.1 trillion assets under management compared to KKR's around 600 billion. This is almost double the second place. And again, I just want to look at the PE ratio as well and see how it's sort of commensurate with the big four, even though they have such much of a higher assets under management.
So now taking a look at our competitive analysis, we want to highlight some of the strengths, weaknesses, opportunities, and threats of Blackstone. So first, looking at their strengths, Blackstone is too big to fail. Over $1 trillion in assets under management, so it's just that big. Along with that, it's the most prestigious AIF, as we've mentioned before, so it's able to recruit that top talent, and it's highly diversified in the real estate portfolio, which is really going to help it hedge against its other investments. Now, looking at some of the weaknesses, its performance is somewhat tied to the economic climate, which can be a downside, and they often have an over-reliance on limited partners and their investors. Now, looking at some of the opportunities, Blackstone has the ability to really engage with emerging industries such as AI, which we're going to talk about later and their unique stance to, and also their ability to take advantage of already captured global markets, especially in the Asian Pacific region. Now, looking at some of the threats, some of the main threats are going to be legislative and regulation. Because Blackstone operates across so many jurisdictions, changes to regulations or legislative policy can really affect Blackstone's operations. And then also geopolitical tensions will do the same thing, especially in the current day where we're having more tensions with other countries. This can really affect Blackstone's operations. Now, taking a look at some of the revenue drivers that Blackstone has, the main tailwinds are going to be this uptick in deal flow that we're going to see within this year and the coming years. Also, the increase in AI infrastructure demand, which Blackstone is going to be feeding. And then finally, Fed rate cuts.
And it's also extremely important to note how we see their real estate portfolio gaining massive ROE in the future, right? So looking at this graph, we can see the interest rate, when it's lower, it sees precipitous growth within real estate housing prices. So as it's 40% of their portfolio, they need this real estate to produce a high amount of return on their investment. And especially considering the fact that the Fed has recently cut rates by 50 basis points in the last month and projected 125 basis points by the end of the year, we can see precipitous growth within their real estate portfolio. And looking at the financials, right, not to get super confusing here, but the free cash flow is the main thing I want to look at, and seeing how it's sort of had a slight downtick. And the rationale behind this is the economic uncertainty. We talked about earlier how private equity and real estate typically ride economic trends, and due to the new shift in presidency and the executive branch and legislative branch within the US, we believe that the main reason that they had a lower revenue in 2024 is due to this uncertainty. And I just want to highlight the assets and liabilities as well in the balance sheet, right? So we typically determine the health of a private equity company to be the ratio between the two. And Blackstone has extremely high assets compared to extremely low liabilities. And this is really important to look at the healthiness and the profitability of Blackstone. And now let's look at the three cases. So we use these for our DCFs. The worst case sort of represents high economic uncertainty versus the base and best cases representing sort of the economic uncertainty dissipating and us having higher earnings within the future. And the EV over EBITDA assumption is very important to look at. So we use both the Gordon growth DCF and a multiples method DCF, and that's how we derived our $198.19 stock price valuation. So again, the three cases with 30x, 27x, and 23x for best, base, and worst respectively. And this is all driven by our comps analysis. So we can see the median EV over EBITDA multiple is 35.4. And we sort of gave a 5x margin for error here, as we do believe that since it's so large, it has less opportunity for growth. And that's, again, why we also noted that the AUM over EV is higher for other companies than Blackstone. So this sort of kind of evens it out.
So now looking at some of the headwinds and mitigants, one of the main headwinds that Blackstone's going to face is obviously going to be the tariff threat. New President Trump has threatened tariffs against countries such as Canada, China, where a lot of Blackstone's portfolios lie, and this can decrease the success rate mainly for Blackstone's private equity portfolios. However, a mitigant for this is obviously going to be that the implied tariffs are going to be much lower than the realized ones, and this only really applies to companies that sell products, so that's really going to affect only a small margin of Blackstone's PE portfolio. Then looking at the second headwind is going to be their inability to deploy dry powder. We're seeing in recent years that Blackstone has been stacking up a lot of dry powder. However, the mitigant for this is that this is obviously a double-edged sword. While it does mean that economic growth is stagnating, it also means that we are prepared, Blackstone's prepared for immense growth within the future, and that they have the capital to be able to deploy that where they need it to go. Now, looking at the ESG considerations, Blackstone scores a 25.2, making it medium risk. In terms of environment, they hosted the Global Decarbonization Summit with their leaders and investors. They've planned on reducing emissions by 15% on their new investments, and they also have strong correlation and ties with the TCFD. In terms of social responsibility, they have several DEI programs to help aid underrepresented communities within Blackstone. They have employee research groups, which help with mentoring, and then they also have the Blackstone Charitable Foundation, which 80% of the employees participate in. In terms of corporate governance, they have an integrated ESG team, and this just helps support those firm-wide initiatives. They have an early leadership pipeline, which helps build future leaders for Blackstone. And then finally, 5 out of the 8 board of directors of Blackstone are independent.
All right, so AI, it's going to be huge for Blackstone to ride the AI wave, mainly to lower diligence and sort of lean down their workforce and recruiting initiatives. So headhunters will no longer be paid as much due to AI being able to recruit for them. We also think they can ride the wave of essentially getting profitable investments, as AI has seen huge growth in the past years, thousands of percent on some AI companies, Cursor.ai, OpenAI, and xAI to name a few. And we also want to note that they've typically ridden the technology wave very well. Social media, content creation, and now AI. They started their investments in 2022, and we see prospective investments to kind of range from over 250 to increase this 101x increase.
So with all that in mind, we make a buy recommendation for Blackstone with a target price of $198.19, and this is going to be realized in fall/winter of 2027.
And again, let's just note the 33.6% increase. We think this is a high increase, and we can bring Blackstone back to its prime of $200 in the past year. And we just want to end off by saying thank you to the judges for considering our pitch and invest in Blackstone.